Friends, what you are witnessing with Ethereum is not just another rally. It is not simply the latest crypto hype. This is a structural pivot, a moment when a technology once on the fringe is stepping into the center of global finance. In 1971, the world quietly crossed an invisible threshold. When President Nixon closed the gold window, he didn't just end the convertibility of dollars into gold. He rewired the global financial system. The dollar became fully fiat, uninsured from a tangible asset, free to expand and adapt. It was a decision many didn't understand at the time. Economists were uncertain, markets were volatile, and yet that single act created the monetary architecture that powered 5 decades of innovation, growth, and digital globalization. Most people didn't realize it then, but they were witnessing a structural transformation, not a policy change, but a paradigm shift. Today, we are standing in a moment that feels eerily similar. Ethereum is not simply evolving, it's redefining what financial value even means in a world where code, not central banks, defines trust. When we draw the analogy between 1971 and Ethereum, it's not for poetic effect, it's because the underlying mechanics are remarkably aligned. Back then, the world moved from a gold-backed system to one built on belief in institutions. Now we are transitioning from institution-backed trust to protocol-backed trust, from centralized issuance to decentralized validation, from static financial architecture to programmable money. The parallels are striking. The gold standard imposed physical limits on monetary growth. Blockchain technology is removing the physical limits of financial participation. In 1971, the dollar became abstracted from gold, a bold departure that allowed money to evolve into a tool of policy, innovation, and expansion. Today, Ethereum abstracts finance itself from traditional intermediaries, turning money into programmable logic, assets into code, and agreements into self-executing contracts. Just as the dollar became the infrastructure for the modern global economy, Ethereum is becoming the infrastructure for the digital one. Back then, few people recognized the magnitude of the change. They saw the headlines, they watched markets fluctuate, but they didn't yet grasp that an entirely new financial world was being born. In the same way, many observers today still view Ethereum as a speculative asset. They track its price, debate its gas fees, or compare it to Bitcoin. But those metrics miss the point. The true value of Ethereum isn't in its price, it's in its function. It's in the migration of trust, liquidity, and creativity onto an open, composable network. It's in the quiet replacement of old financial rails with transparent, efficient, borderless systems. Consider what's happening beneath the surface. Institutions are tokenizing assets, real estate, treasuries, equities, using Ethereum standards. Developers are building financial products that settle instantly, without intermediaries. Global payments, lending, and even identity management are finding new foundations in this programmable infrastructure. This isn't hype, it's structural migration. Just as fiat finance reshaped markets, Ethereum-based finance is reshaping value creation itself. The shift in 1971 unlocked an era of exponential innovation, credit expansion, digital banking, and eventually the internet-driven financial globalization we know today. Ethereum's transformation holds the same potential, but on a faster timeline. By making finance composable and code-driven, Ethereum opens the door for exponential experimentation. We are no longer bound by national borders, institutional gatekeepers, or the pace of regulatory evolution. The system can evolve at the speed of software. Of course, transitions like this are rarely smooth. The 1970s brought inflation, confusion, and growing pains, yet out of that turbulence emerged the foundations of the modern economy. We should expect something similar today: volatility, debate, and resistance, but also progress, creativity, and a reordering of what financial power looks like. When historians look back, they may not remember today's price charts or short-term volatility. They'll remember the moment the world moved from centralized trust to decentralized computation, from belief in institutions to belief in code. Ethereum's 1971 moment is not a prediction of price, it's an acknowledgement of change. We are living through the digital unshackling of finance, a quiet revolution that, like Nixon's fateful announcement, will only reveal its full magnitude decades later. And just as few in 1971 could imagine a world of smartphones, algorithmic trading, and global digital commerce, few today can truly grasp what a fully tokenized, decentralized, programmable economy will look like. But one thing is clear: the rails are being laid, the architecture is emerging, and just as the dollar became the backbone of the 20th century economy, Ethereum may well become the foundation of the 21st. Over the past few years, something extraordinary has been happening quietly behind the scenes. What began as an experiment in decentralized computing has started drawing the attention of the very institutions it once sought to disrupt. The narrative around Ethereum is no longer confined to developers and retail traders. It's increasingly being written in boardrooms, on trading floors, and within the strategy documents of global financial firms. Institutions are no longer looking at Ethereum as a volatile curiosity. They're starting to view it as infrastructure. And that changes everything. For decades, legacy financial systems have operated on rails that are, at their core, outdated. Settlement delays, opaque intermediaries, high costs, and limited accessibility have been accepted as normal. Ethereum challenges that entire architecture. It offers programmable money and transparent, immutable ledgers. It allows assets to move across borders instantly, with verifiable authenticity and trust established not through institutions, but through code. For large-scale financial entities, this isn't just innovation, it's efficiency, scalability, and security all rolled into one evolving ecosystem. The inflection point is clear. Over the past 2 years, major institutions, banks, funds, asset managers, and even governments have begun building on Ethereum's framework. Tokenization has emerged as a major theme. When you tokenize a bond, a real estate portfolio, or even a piece of fine art, you make it programmable, fractional, and globally accessible. This isn't theoretical anymore, it's operational. Major financial players like JP Morgan, BlackRock, and Franklin Templeton are actively experimenting with tokenized funds, many of them on Ethereum or Ethereum-compatible networks. The idea that capital markets could operate 24/7, settle instantly, and be audited in real time is becoming less like science fiction and more like a new normal in motion. Staking is another area redefining institutional participation. What once seemed like a niche yield mechanism has evolved into a new model for treasury management. Institutions are beginning to view staking yields as a predictable, transparent return stream, almost like digital bond coupons generated by validating network activity. It's a new income layer built on trustless computation. For corporate treasuries holding digital assets, staking provides a yield opportunity that doesn't rely on traditional banking systems or credit exposure. This convergence of yield and security is fundamentally rewriting how institutional capital thinks about blockchain exposure. Meanwhile, Ethereum's transition to proof of stake has transformed its energy profile and regulatory perception. What was once criticized for environmental inefficiency is now one of the most energy-efficient, secure settlement systems on the planet. This matters deeply to institutions, especially in an era when ESG principles guide major capital flows. The combination of sustainability, transparency, and yield potential makes Ethereum not only technologically compelling, but institutionally palatable. The migration to Ethereum-based infrastructure extends beyond finance. Supply chains, insurance, carbon markets, and identity systems are beginning to integrate with Ethereum's Layer 2 and Layer 3 scaling networks. This multi-layered expansion is what gives Ethereum its resilience and adaptability. Layer 2 networks like Arbitrum and Base enable higher throughput and lower fees, allowing enterprise-scale operations without sacrificing security. It's the same architectural shift that took the internet from slow, dial-up beginnings to a global, frictionless network that runs our economy today. The most powerful part of this evolution is that it's happening in plain sight, yet few grasp its scope. When you see an asset manager tokenize billions in treasuries, when you see a multinational bank pilot instant settlement through Ethereum, when you see stablecoins settle trillions annually, what you're really witnessing is migration. The same kind of migration that occurred when the world moved from paper ledgers to digital databases. The difference is that this time the destination is open, interoperable, and trustless. This is how revolutions look before they're recognized as such. Institutions are not just investing in Ethereum, they're integrating into it. They are moving liquidity, operations, and settlement processes onto a new set of rails. It's a quiet but profound acknowledgement that the infrastructure of finance is evolving faster than the regulatory frameworks designed to contain it. History teaches us that the institutions that adapt early to paradigm shifts often lead for decades afterward. The ones that cling to legacy systems risk being left behind, not because of ideology but because of efficiency. Ethereum offers institutions something legacy finance has struggled to deliver: programmable trust, continuous liquidity, and composability. Each new integration, each new experiment, each new tokenized asset brings us closer to a world where global finance runs on open source infrastructure rather than proprietary silos. We are watching, in real time, a migration of trust away from intermediaries and toward networks. It's subtle, it's technical, and it's inevitable. And just as the internet quietly rewired how information flows, Ethereum is now quietly rewiring how value moves. Institutions are not just joining the network, they're becoming part of it. For years, the debate has circled around one provocative question: can Ethereum surpass Bitcoin in value? On the surface, it sounds like a contest between two digital assets, but in truth, it's a deeper conversation about function, evolution, and what ultimately defines value in a digital economy. Bitcoin is often seen as digital gold, a pristine store of value. Ethereum, on the other hand, is infrastructure. It's the operating system for decentralized finance, digital assets, and tokenized economies. And that distinction is precisely what underpins the growing belief that Ethereum could one day flip Bitcoin in total market capitalization. Value, after all, follows utility. Bitcoin was revolutionary in proving that decentralized consensus could create digital scarcity, an incredible breakthrough that reshaped our understanding of money. But Ethereum took that innovation and built upon it. It expanded blockchain's capabilities from being merely a ledger of ownership to becoming a programmable platform for innovation. Every stablecoin, every decentralized exchange, every non-fungible token, every tokenized treasury bill, much of it exists on Ethereum or its compatible networks. That ecosystem effect compounds value. It transforms Ethereum from an asset you hold into infrastructure you use. When analysts discuss Ethereum's valuation, they increasingly turn to frameworks that go far beyond speculation. Traditional valuation models for network platforms, like Metcalfe's law, apply neatly here. The value of a network grows exponentially with the number of participants and the intensity of their interactions. Ethereum doesn't just have users, it has developers, enterprises, decentralized applications, and entire industries being built on its protocol. Every new integration, every contract deployed, every token issued increases the gravitational pull of the network. This is not just growth, it's network effect in motion. The emergence of real yield adds another layer to Ethereum's valuation thesis. With staking now embedded in its consensus mechanism, Ethereum has created a native yield engine, one based not on debt but on participation. The staking yield represents a fundamental shift. Value accrues to those who secure the network, not to centralized intermediaries. In traditional finance, this would be the equivalent of owning a stake in the infrastructure of the entire banking system and being rewarded for maintaining its integrity. This yield-bearing dynamic strengthens the investment case, offering predictable, transparent returns within a decentralized framework. Meanwhile, the rise of tokenized real-world assets could become the catalyst that redefines Ethereum's intrinsic value. When treasuries, bonds, equities, and commodities begin to migrate onto Ethereum's blockchain, the network ceases to be a niche experiment. It becomes the digital foundation for global liquidity. Some forward-looking analysts already model Ethereum's potential valuation using total addressable market estimates for global financial assets. In those frameworks, even modest penetration rates lead to valuation projections that sound almost implausible today. But so did cloud computing or the smartphone revolution in their infancy. The flip narrative, Ethereum overtaking Bitcoin, isn't about rivalry, it's about evolution. Bitcoin represents the first chapter in decentralized value. Ethereum represents the architecture for everything that comes next. If Bitcoin is digital gold, Ethereum is digital civilization, the platform upon which value, identity, and information can converge without intermediaries. Its growth is not bound by scarcity alone, but driven by innovation, productivity, and adoption. Another key factor in this shift is monetary dynamics. Ethereum's transition to proof of stake introduced a deflationary element. With EIP 1559 burning a portion of transaction fees, Ethereum's supply can actually shrink as network activity grows. That means the more Ethereum is used, the more scarce it becomes. It's a remarkable inversion of traditional monetary logic, where usage fuels scarcity rather than inflation. This feedback loop ties economic growth directly to asset appreciation, creating a sustainable engine for long-term value. Of course, no structural shift happens without friction. Bitcoin's narrative is entrenched, its simplicity unmatched, and its role as pristine collateral remains powerful. Yet history shows that technological platforms with broader utility often surpass their predecessors in value, even when those predecessors seem untouchable. The internet eclipsed telephony, the smartphone replaced the personal computer, and now programmable blockchains are poised to redefine the function of money itself. If we accept that markets eventually reward productivity, then Ethereum's role as a platform for global digital value creation could indeed justify a market capitalization beyond Bitcoin's. It won't happen in a day. It will happen as adoption compounds, as more capital flows on-chain, and as institutions and individuals alike begin to transact, save, and build atop Ethereum's rails. This is not a speculative dream. It's the natural trajectory of innovation meeting scalability. The question is not if Ethereum can flip Bitcoin, but when the world fully recognizes that the rails of the next financial era have already been built, and they are running, quietly and powerfully, on Ethereum. Every technological revolution carries with it a paradox. The bigger the opportunity, the greater the risk. Ethereum stands at the heart of one of the most transformative moments in financial history, but it also faces the challenges that naturally accompany paradigm shifts. The world is not just waiting to see whether Ethereum can scale or innovate, it's waiting to see whether it can execute, whether it can sustain growth, attract institutional trust, navigate regulation, and deliver on the promise of an open, decentralized financial future without losing its core principles along the way. The risks aren't theoretical, they're structural, technological, and psychological. Ethereum is attempting something that has never been done before, rebuilding global finance on a trustless, programmable base layer. That ambition brings extraordinary potential, but also extraordinary complexity. Scaling is one of the most persistent challenges. Even with the rise of Layer 2 solutions and network upgrades, Ethereum must balance decentralization, security, and scalability, the trilemma that defines blockchain development. Too much optimization in one direction risks compromising the others. And while new technologies like sharding and rollups are accelerating throughput, they also add layers of technical interdependence that must operate flawlessly to maintain stability. Then there's the regulatory frontier. Governments and central banks around the world are grappling with the implications of programmable finance. Ethereum, being the infrastructure upon which stablecoins, DeFi protocols, and tokenized assets run, often finds itself in the crosshairs of policy debates. Will regulators embrace innovation and create frameworks that foster growth, or will they impose legacy rules on new systems and slow the pace of adoption? That uncertainty can influence institutional participation, liquidity, and capital flows in the near term. But if history is any guide, technological innovation tends to outpace regulation. Not by defiance, but by necessity. When a system proves it can create value more efficiently, adoption eventually forces accommodation. Execution risk extends to governance as well. Ethereum's evolution depends on decentralized coordination, developers, validators, and communities aligning around upgrades that can reshape the network's core. The transition from proof of work to proof of stake was a triumph of coordination, but it also underscored how fragile consensus can be. Maintaining this pace of innovation while avoiding fragmentation is one of the greatest strategic tests for any open-source network. Each upgrade introduces opportunities but also potential vulnerabilities. A single exploit, a failed fork, or a loss of confidence in consensus mechanisms could ripple through the ecosystem. Timing also plays an enormous role. Technological adoption rarely happens in a straight line. The Internet, too, experienced cycles of hype, disillusionment, and rebirth before its real potential was recognized. Ethereum's adoption curve will likely mirror that same pattern: waves of enthusiasm followed by consolidation, correction, and renewed growth. Long-term investors and visionaries understand that volatility is not noise, it's part of the process. Each downturn shakes out speculative capital and strengthens conviction capital. Those who understand the underlying trend, the shift from centralized to decentralized infrastructure, recognize that the timing of success isn't about days or months, but decades. Competition poses another dimension of risk. Ethereum may have the first mover advantage, but innovation in blockchain is relentless. Competing layer 1s and modular architectures continue to experiment with new ways to optimize cost, speed, and interoperability. Yet, as we've seen in technology cycles before, network effects often determine long-term dominance. Just as Windows, Android, and the Internet Protocol stack maintained leadership through composability and developer ecosystems, Ethereum's vast developer base and institutional integrations may become its strongest moat. But moats must be defended through execution, upgrades, and relentless improvement. Economic risk must also be acknowledged. As Ethereum increasingly becomes the foundation of tokenized assets and global liquidity, macroeconomic shifts, interest rates, regulatory cycles, geopolitical tensions will influence how capital interacts with it. In 1971, the abandonment of the gold standard unleashed both inflation and innovation. Similarly, Ethereum's rise may coincide with moments of turbulence as the world adjusts to a new form of financial architecture. But volatility, when seen through the lens of innovation, is often a signal of recalibration rather than failure. Execution, in the end, will define this era. Vision without execution is speculation. Execution without vision is stagnation. Ethereum's success will hinge on the community's ability to continue building, refining, and scaling while remaining open, secure, and composable. Each upgrade, from scalability enhancements to interoperability bridges, must serve the broader goal of decentralizing access and enabling new forms of economic creativity. We are witnessing an inflection point where technological capability meets institutional validation. But the road ahead will test endurance as much as imagination. Those who see this transition clearly understand that revolutions are never smooth. They are uneven, iterative, and often misunderstood in real time. Ethereum's trajectory will not be defined by how fast it moves in a single cycle, but by how consistently it executes across many. The winners in this story will be those who understand that timing isn't about catching a wave. It's about staying aligned with the tide.